Hey folks, Dave Nadig, financial futurist here at VettaFi. As part of our exploration of Canada and the ETF market, I sat down with Helen Hayes, who's the head of iShares for BlackRock in Canada. We talk about what's unique about Canada as an investable market, but also as a collection of investors. We talk about the importance of fixed income, we talk about taxation, we even get into what's unique about the Canadian economy and how its traditional reliance on resource extraction and energy and natural resources puts it in a really interesting position when you think about things like carbon transition, net zero. I think it's a really fascinating conversation. I hope you enjoy it. Cheers. So in talking to other folks in the business here, like one word comes up over and over again, which is community, which I find interesting because this is a very competitive market.
Yeah, we're co-competitors.
Co-competitors.
Like, I think that if you think about sort of the word is that like Canadians generally are nice.
Right.
And B, that in finance we all know each other. So it's co-competition where we work together. But at the same time compete. So we might sell like a technology system like Aladdin to one of our competitors. We cooperate, but we're also competitors.
But like that kind of competition, like iShares came to market. You
Yes.
guys established a pretty strong partnership with one of the big six here.
RBC.
Yeah. And you've done a lot of co-branding. But there are now 40 competitors in this marketplace, and not all of them have a relationship with one of those big banks. How important is it to partner in this business?
Yeah, so I think from a perspective of partnering, and it's the RBC Alliance, and we're in our fourth year of this relationship. It was structured prior to me joining iShares. We work together. Our alliance, from a perspective of our products, we co-create products from a perspective of iShares and then RBC ETFs. So we're distinctly different, but we come together under the umbrella of branding of RBC iShares.
And the way you guys have sort of divided up the playing field, RBC's focused on their active management capabilities largely, right? Am I correct in that?
Yeah.
And you're sort of bringing BlackRock's history of just being a dominant player in the passive space. And so that's sort of the marriage up here?
Yeah, but I wouldn't say in the future you'll never see an active product from us.
Right. Where are you finding the fits here?
Fixed income has been an area of strength, and we've seen significant flows. So for iShares Canada, we have seen about $1 billion of flows across our fixed income products so far this year. And I think what's great about an ETF is it's an accessible financial instrument. And so when you're building out your portfolio and when you think about asset allocation, ETFs make it really easy for whether you're an individual from a retail lens, whether you're an institution who wants to get a certain exposure within your portfolio from an asset allocation perspective that's liquid. You can pick any exposure using an ETF, but for fixed income, it really adds the opportunity to get size and scale in a very liquid way in fixed income.
And Canadian investors have historically just been addicted to yield, right? I mean, this has been one of those markets where getting yield out of any asset class you can has been dominant. Obviously, the sort of huge prevalence of things like covered call strategies here, any way to extract income from the world, that clearly must have shifted now that we have a live rates market and all of a sudden you can actually get paid something for owning fixed income. Has it changed how the asset allocation part of the world has worked? Because again, that's a fairly unique Canadian marketplace. Asset allocation ETFs don't exist in most of the rest of the world.
Certainly our XGB, which is our Canadian government bond ETF, has led all flows. But what's been interesting on the front end of the curve, XFR, which is our floating rate ETF, has had significant inflows. And when you think about the adoption earlier in the year of high interest rate savings account ETFs, XFR now yields because it's floating rate. And obviously we're in an environment where we've continued to see the Canadian rate environment increase. And it's got almost a 5% yield now. And with what we heard from the Bank of Canada yesterday. That will continue to increase. And so you're actually getting a better yield with XFR than you are HISA at the moment.
And again, a somewhat unique feature of the Canadian market is this real comfort level with floating rates to start with. I mean, most of the Canadian mortgage market would be unrecognizable to a U.S. borrower who just generally buy 30-year fixed mortgages.
And can stay with it.
And stay with it forever. Y'all are very much more used to sort sort of going with the flow in terms of, well, I guess money costs 10%, it used to cost 5%. Do you think that that's part of it, that investors are willing to be a little bit more short term and looking for those opportunities?
Absolutely. So, even when I look outside of fixed income and I look at some of the flows that we've seen from a factor perspective, dividends have been another big area for us in terms of flows year to date. So I think Canadians, generally speaking, you have a 5-year term on a mortgage, and depending when that rolls over. So our mortgage market is definitely different, which I'm sure plays into people being more comfortable and a certain acumen in the market in terms of financial literacy of people paying attention to where interest rates are.
People are very concerned about these markets still, even though we've had this incredible recovery after last year. How do you think that the market's playing with that? Because we see things like dividend funds pulling in a lot of money. We see the short end of the bond curve pulling in a lot of money. And we see, products that are up 20, 30% this year not pulling in assets. That's a bit of an oxymoron in my experience. Usually money just chases performance. What do you think's going on?
Again, 2023, the year of expect the unexpected. So you start in March, Dave, right?
Yeah.
We didn't know that was coming at us.
Yeah.
We dealt with that. That led to what I would say is an asset allocation shift. Again, people thinking about fixed income, people thinking about exposure within their asset allocation call. What we've now seen is this concentration of 7 stocks that have made up the performance, whether you look at the NASDAQ, whether you look at the S&P. I mean, we've had such
if you look
huge
at
growth.
Yeah. I mean, it really is dominant.
We've had a concentration issue. Yeah. So now, and I think this is why we're seeing flows into places like emerging markets, or EFI, which is Europe, Australasia, and Far East. And what's been interesting is people are worried about this. So they have taken their lens, their cap off and said, okay, I am worried about the second half of the year. I've got my fixed income exposure here, but now I want to look in other parts of the world because I am worried when these companies start reporting they're outside of this concentrated 7 stocks. I'm really worried about what results are going to look like in the next earnings cycle.
Right.
So I'm going to shift to lower valuation. If you think about emerging markets, Dave, what's interesting is we are at a place now in emerging markets where valuations are lower. Secondly, I would say to you that they might start cutting rates sooner than we're going to see in North America. We're still increasing rates here, right? And I would say to you that that from an EFI perspective, and within our products, if I think about where we've had flows like XCF, which is our MSCI related emerging market product, it's been fascinating to see the flows, like significant flows going into these products. And I think it's about people, again, shifting and hedging their bets, especially institutional clients.
Yeah, it feels like, I mean, you called it an asset allocation shift. That's more what it feels like. It doesn't, a lot of the times when we see big shifts in flows, it's chasing something.
Right.
Cannabis stocks, crypto, whatever it is, whatever the hot dot of the moment is. This doesn't feel like that at all. This feels like a rearrangement of the expected norm. Do you feel like there's a difference between what the sort of direct investor retail folks are looking for and need out of the market? Is there a difference between that and what the more sort of advised walk into the bank branch, sit down, really build a financial plan? Those can be very different markets. Do you feel like you have to deliver different products or different solutions to those two different markets?
Well, I think we think all the time about how can we provide solutions to clients. Again, whether you're an individual retail investor, whether you're an institutional investor, whether you're somewhere in between. Family offices are an area that have grown tremendously in Canada, where 5 years ago we wouldn't have the number of family offices that we have now. So we're in a unique situation where I think the market is shifting from a perspective of the retail investor, the family office, and the institution, and we're getting sort of a blended perspective in terms of what people are looking for. So obviously everybody knows about the meme craze that we had during the pandemic. I think what's happened now is people are going back to work, and so from that perspective, they're now less time maybe to do day trading, but I still think the stats are showing that people are still spending a lot of time, and the retail investing community continues. And then when you shift over to that family office, you've had this prevalence and growth of smaller players in the Canadian market that have grown assets and that are serving what I would say what's between a larger institutional mandate and a retail mandate. So that institutional or that family office that sits in between is quite fascinating because it might be they're looking for a range of solutions for their clients. And it's about educating. You know, we spend a lot of time thinking about how do we get our message out to the market? How do we educate people both about the attractiveness of a fixed income or an equity sleeve within your investing perspective?
Let's hone in on that. So how are you getting those messages across? It's a crowded market out there right now. There's a lot of noise. We know that investors do a lot of online research before they make any decisions. How are you getting the message across?
We spend a lot of time in market. So what's happened since the pandemic is the shift back to being on the road. So we have an ETF specialist team here at BlackRock that works in conjunction with our RBC partners. So they're out in market talking to people. They're out doing road shows again. And then we add to that from a perspective of getting written materials and videos out, talking about our products to clients, because education really is key. And as I said, you've mentioned that the ETF market has really grown significantly. And with that growth, there is a need to educate people on liquidity, on accessing different exposures, which is critical, and really being able to use an ETF as that liquidity vehicle within your portfolio. So you may decide, I would like emerging markets exposure. I'm really concerned about what's happened in the US. Valuations have run up significantly. I want to go out, and I also like ESG. So I want to access a product that is not only emerging markets, but that has also got a ESG tailoring to it. And so, for example, our XSEM, which is within our Aware suite, which is our MSCI emerging market, is our number one ticker from a perspective of almost $2 billion of inflows this year. That again is an ESG or sustainability related product within our suite, but that has exposure to emerging markets.
Right. And do you have a vibe on whether or not that's retail investors, whether that's family offices with sort of really strong mandates that we must have some level of ESG over the portfolio? Do you know where that's catching?
Yeah, so I would say that would be more institutionally related, right, in terms of exposures. But what's been fascinating, and certainly not something that if you had asked me at the beginning, Q1, the beginning of 2023,
I wouldn't believe it either, yeah,
that we would have had this movement into emerging markets, I really wouldn't have thought that we would see it. And I think,
frankly, ESG, which certainly sort of fell out of bed last year.
Yeah, and I think, transition and sustainability is where people are shifting to in the market, and it's a narrative that is perhaps more palatable from a perspective of thinking about your portfolio and thinking about that word transition. So, for example, if you want to own energy and you want to have a transition overlay, thinking about a nuclear, thinking about a way to create an index or an ETF that brings the transition or inputs, stocks that are bringing the narrative to life around transition, you can do that through our products.
And Canada must be like particularly focused on this being a natural resources economy, right? You're sort of doubly exposed, not just climate change, which affects literally everyone.
Yeah.
But in Canada in particular, because of the historical reliance on extraction of some sort, that must be a sort of top of mind thinking, like what does the economy of Canada look like in 20 years? Through a transition like that, right?
Yeah, because if you think about the Canadian index, you are talking about financials, you are talking about energy, and you're talking about materials. Right. That is, if you look at the TSX 60, that is the dominant composition of our index. So 100%.
How do you develop for that? Because it does seem fairly unique to Canada, certainly versus south of the border.
Well, I think at BlackRock, we have expertise in building product. So we look at the market all the time. We're looking at current investor themes, and it's all about the client. We are led by our clients. So we look at where we have gaps in the market. We'll look at where across BlackRock, iShares has been successful in other areas, and we think about what would fit for Canada. So certainly looking at the Canadian market and thinking about that transition sustainability narrative, we look for holes and then we start building out. So we have a product strategy person who is in contact with all our partners across the globe. And that's part of the power of BlackRock is because we're such a dominant player in the industry is learning from one another, leveraging best practices and also best products and thinking through how do we meet our clients' needs.